I want to tell you about the greatest business model in the history of human civilization. It's not Amazon, it's not Apple, it's not the oil industry, it's your bank. And the most beautiful, or depending on your perspective, the most diabolical part of it, you funded it. You're literally financing the thing that's charging you to exist. Here's how it works, and I promise you, this is not a conspiracy theory. This is an economics textbook. It's just that nobody ever handed you the book. Let's say you deposit $1,000 in your bank account. You feel good, responsible even. Hell yeah, you're adulting. You got a little notification on your phone, deposit confirmed, and you go about your day thinking your $1,000 is just sitting there waiting like some loyal, over-friendly golden retriever. Too bad. It's not sitting there. The second you walked out of that bank or closed that app, your $1,000 got to work for them, not for you. Did you hear what I said? Your money went to work for someone else. So much for your whole loyal puppy thing. It's called fractional reserve banking, and it means the bank is only legally required to hold a fraction of your deposit, which has historically been around 10%. Yeah, that part. The rest of it? They loan it out at 7, 12, even as much as 29% on credit cards. Oh yeah, you're not in Kansas anymore, Dorothy. Your money, their profit. You lend them your money every time you make a deposit. Up until now, you haven't been a very astute banker and they know it. So they convinced you that all you deserve on the loan you extended to them is fractions of a percent in interest. Then they turn around and make triple-digit returns when they lend it out and laugh at you all the way to the proverbial bank. Oh, and by the way, sunshine, you could deposit $100,000 in the bank today and ask to borrow $20,000 tomorrow. They're still going to make you apply for a loan. They could and often will decline your loan application. Consumer bankers call it risk underwriting. We call it control. How empowered do you feel now, Mr. Moneybags? I know, I'll try not to tread on your finer sensibilities. That was callous of me. But we got to get you out of the system, my friend. Success should never feel this helpless. So let me do this goofy math out loud, slowly, so the whole class can get this together. You deposit $1,000, they keep $100 in loan, out 9 at 29% interest on a credit card. They earn roughly $261 in interest. They pay you, at a typical savings account rate, about $450. So on your money, they made $261, and banks make more than 2,900% on other people's money. It's usually much, much more than that. Just think about it. You made a measly $4.50. Hell, that's not a savings account. It's a charitable donation with extra steps. What's your dad gonna say when he finds out you keep letting that bully take your lunch money? Now, where does 2,900% come from? Because I know that number stopped you dead in your tracks, and it should have. Here's the thing about banks that most people don't fully grasp. They don't just loan your money once. They loan it, it gets deposited somewhere else, and then that bank loans it again, and the next bank loans it again, and again. It's stinking Groundhog Day, and the only shadow being seen is the one of your $1,000 while it's off in the night making cold hard cash for someone else. But I digress. Let's get back to the point. It's called the money multiplier effect. And through this mechanism, a single dollar deposited in the banking system can be multiplied, lent out repeatedly by a factor of 10 or more. Ooh, you thought the game was one-on-one when it's always been 5-on-1. It's like being told you were gonna meet a friend at the gym to play a friendly game of basketball, and when you get there, Shaq is blocking all your shots like you stole his 10-speed bike in 5th grade. You're never gonna win this game. When you look at the total return the banking system generates from a single deposited dollar across all those lending cycles compared to what the original depositor earned, the spread is enormous, thousands of percents. The exact number varies by environment, by rate, by reserve ratio. But the point is the same. The architecture of this system is designed to generate extraordinary returns from other people's money. Your money. That's the oldest wealth-building principle in the game, and they've been playing it with yours since the day you opened your first account. But I'm not mad about it. I'm genuinely not, because the bank's not breaking any rules. They invented the rules. What I am saying is, now that you know the rules, what if you played by them? Banks, specifically the large ones, hold what are called Tier 1 capital reserves, the money they are required to have on hand to remain solvent. You know what a significant portion of that capital is held in? Life insurance, specifically cash value life insurance. They call it BOLI, bank-owned life insurance. JP Morgan holds billions in it. Wells Fargo, Bank of America, the very institutions that are charging you $35 overdraft fees are simultaneously holding billions of dollars in cash value life insurance policies because they understand something most of their customers don't. Cash value life insurance, specifically an indexed universal life policy, what we refer to as private banking contracts, when properly structured, do what your savings account pretends to do. They hold your capital, they grow it, linked to market indexes, protected by a floor so they can't go backwards, and you can borrow against them tax-free with no credit check and completely on your schedule, so your capital keeps compounding while you put it to work somewhere else. Armed with the same tools used by the wealthy for decades, you and your family can build, grow, and protect multi-generational wealth and change your cultural banking legacy forever. You become the bank. Not metaphorically, but architecturally. You are now the entity that holds the reserve, earns the return, and controls access to capital. You are no longer the depositor funding someone else's 2,900% ROI. You are the institution. I'm an educator, not a licensed agent. I don't write policies. What I do is utilize my 35 years of financial and capital markets tenure, decades-long wealth-building experience, and 25 years of pedagogically sound training to make sure you understand what's possible before you decide what to do about it. If you want to understand how the private banking model actually works, how to construct it for free, what it costs, what it does and doesn't do, visit us at fourthwish.com. The education is free. The insight is priceless. And at least now you'll know what the bank knew all along. Once you're satisfied with the information and are prepared to build your private banking system, our team of licensed private banking architects will help you change the way you bank. I look forward to our conversations. Talk soon.